Great.
Would you like me to introduce you?
Yeah, sure. Why not? That's always kind of nice.
Oh, sorry, what's your name?
Tom. Hamish and Tom.
Hamish and
Tom. Nice to meet you.
Nice to meet you.
Yeah.
Steph, nice to meet you. Where do you think you'll be speaking? Will you be walking or will you be around?
Look, I don't need to walk around, so if we're being recorded, I'll try and stick to this area.
Okay, sure.
I've got a relatively loud voice anyway.
Okay,
so
yeah, I'll probably just leave the phone here. We just want a better recording. Hi everyone. Okay, it's not on. Hi everyone. We could just have a little bit of silence, please. Thanks. All right, everyone, thank you so much for coming to the Saxo Trading Workshop. We're really excited to have you here. My name is Steph, and I'm the president of unit at the University of Sydney. I'd love to introduce to you Tom and Hamish, who are from Saxo, and I think it's about a good time to start, so I just leave it to them. Thank you so much for coming.
Thank you very much, Steph. As Steph had said, my name is Hamish, and I'm from Saxo Capital Markets. The Sydney office that we have in the CBD is one of 25 offices that Saxo Bank owns globally around the world. It's a small European bank with about 1,300 employees that deal with both retail and investment banking, and its flagship product really is the online trading platform. Now, we've been invited here today to present in front of you to really bring together the theoretical knowledge that you were learning about at university, to tie it in with some practical application on using a platform and how to get your knowledge into really making money in the market. And then, of course, running then the stock market game that we have off the back of it, or the trading game we have off the back of it, to really make sure it's driven home and you really make something of the opportunity. There are prizes available for those that win, and I understand that we've got a number of universities across Victoria, New South Wales and Queensland that are participating this year. To give you a bit of a rundown on how this presentation will flow through, I'll start off and tell you a little bit more about how Saxo Bank was created, before rolling through the ideas of really how you really make money in the market, before moving on, where I'll pass it over to my colleague Tom, who will tell you about the products that we have available on our trading platform, most importantly the ones that will be applicable to you in the game, and then he'll also run you through a live demonstration of the platform, placing trades, and then tell you a little bit about the game at the end as well. So kicking it off, there's a disclaimer, nothing I say is of personal advice. Please don't sue me if I say something and it goes the other way. So look, a quick rundown on how Saxo was founded. Basically, there were two sales guys that were dealing in FX, and they just had a number of clients that were actually wanting to place trades themselves. Online share trading in the US had just started off, and these two guys who were very entrepreneurial just really had a first mover advantage, took calculated risk, and it really paid off for them. So over the next decade, as this trading platform advances from just foreign exchange to incorporating other products like futures and options and the like, they then have enough capital behind them to actually launch a bank, which is run out of Copenhagen and has been in operations for a good decade or almost two. The bank, as I was saying, has a flagship trading product and overall has daily turnover of about 20 billion Aussie dollars. We have 25 offices globally, speak about 40 languages, the dominant one of course being English, and we typically have four kinds of traders or four kinds of investors. The first is really the high net worth investor, and they're typically your institutions and fund managers that have got a lot of capital at their disposal. The next one is really the sophisticated trader. So somebody, and I have no doubt a number of you in this room will eventuate to that as time progresses, where you are very knowledgeable in the financial markets. You're typically trading your own money. You'll have a couple of million in your back pocket and you're very savvy and knowledgeable. I like that you're nodding your head to that. That's a good sign. Then you'll have the self-directed investor, a little bit more mum and dad like, a little bit more of a buy and hold. as they sort of build their wealth in life. But one thing that I've certainly noticed since moving across from an online stockbroker in Australia to actually Saxo in Australia is that our self-directed everyday trader is far more savvy. They're not your buy and hold, they're not just orientated in shares, but they really are out to make money in whichever asset's going to make them the most money. And it's actually quite interesting. So jumping through now from who Saxo is to really kind of talking about how on earth you're going to make money, and the simple answer is buy low, sell high. Ultimately, there are two ways you're going to analyse an investment. It's going to be on a fundamental level, or it's going to be on a technical level. And the very best of them really do blend the two to a degree. Fundamentally, as I'm sure a number of you will be brought across by now, is ultimately analysing an asset, or let's say a stock, to really determine what its intrinsic value is. If the value is lower than what the market is offering if the intrinsic value is lower than what the market's trading at, then you'd want to short the stock, sell it at a high price, and when the two merge, you would then buy it back at a lower price. Alternatively, if the intrinsic value is higher, you obviously buy low in the market, wait for the price correction before selling out. Now, there are a number of different ways that you can actually take up a fundamental valuation. Undoubtedly, on the very top here where we've got discounted cash flows, you are all undoubtedly well aware of the discounted cash flow model. The price of an asset today is tomorrow's dividend divided by the return minus growth. Sometimes the flaw in this model is that it's very simplistic, but it does have a very good basic understanding behind it. How much will I pay today for a continual stream of income in the future? Now, an advancement on this model, and I don't know how much this is taught in universities, I don't think I caught it when I was at university a good decade or so ago, but is the H model. And this model will actually take that formula and evolve it to a degree whereby you can actually implement it for a growing company or a growing country, an emerging country. And it'll look at the growth rate, let's say China's 7% that they've been operating on for a long time now, and how they are now actually starting to deteriorate away and will eventually end up where the US and Australia is dancing around I was going to say 3%. That's our long-term average, so we'll stick with 3%. And therefore you can then price the asset more appropriately. Now, for any of you that move on from university, continue in finance, and look to study with the CFA, the Chartered Financial Institute, they're very strong on the next two cash flow models, which is free cash flow to the firm and free cash flow to equity holders. Each model is slightly different, and you have different reasons as to why you would use these fundamental breakdown of cash flows. The free cash flow to the firm really just looks at the core operating unit of a company. It rules out anything like if the company is in manufacturing and it sold one factory in the heart of the CBD and moved out to Bella Vista, that they've accidentally made a couple of million on that factory, because it's really not part of their operating unit. It's not in property. Their money is made in, I don't know, furniture or clothing or whatever it might be. And so it really breaks down how much money that firm makes from its core operations and how much it can reinvest in itself. And it might be through capital expansion, it might be through networking capital, or marketing, all the rest of it. Where the free cash flow to equity holders takes the approach more along the lines of that, how much money can the shareholders extract from this company while keeping it still operating in a robust fashion. Typically, if a company if it's very large and it's looking to be taken over, it's also a very good model to use for the target, predominantly because they can then tweak the numbers to how they would actually run the ship and what the end result would be from that. Now, whenever you're actually analysing one of these companies, and you might start to favour one model over another, although you should very much be choosing the model that is applicable to the size and cash flow of your company, or if it's actually even making positive sales. It is nice to actually pair it off and just sort of put your finger in the wind and just get a sense if another model gives you a similar valuation. Because in theory, all these models should come together and pretty much give you the same market price and intrinsic value. And so the relative valuation model looks at a company's PE ratio, book value, price to shares, dividend payout ratios, and the like, and net profit, to really sort of get a gauge of where one company is in comparison to another. And the Australian banks are a very good example of this. Whoa, I need to touch this screen more. The big four are actually a great example of this. You've got CBA, who's recently been trading with a PE ratio of about 15. You've got NAB, who's been trading at about 13.5, and the other two are somewhere in between. Now, they're all fantastic businesses generating great cash flow. So why is it that NAB is actually trading a little bit lower? And as you sort of look into a couple of reasons, you sort of see that they've got some weak UK assets. CBA is operating a little bit higher because it's heavily involved in the Australian residential property, and that's been going gangbusters. But overall, they do ultimately meet each other and merge together. And so opportunity can be brought about that in a day of bad performance and one of these does drop enough, you can actually then look to pick it up on just a relative valuation model. Relatively simple to do, data can be found in the market with enough ease, and it can be applied relatively easily. Private equity, I won't touch on too much. A number of you may go into hedge funds or into private equity firms, and this will be more relevant, but it's a little bit large for the scope of today's presentation. And so I'll tell you a little bit about the multi-factor model, which then will wind in well with the next slide, which has to do with information trading. I have no doubt that a number of you have already learned about the multi-factor model and about how either the expected return of a company or perhaps the expected price of a company is predominantly dictated by a number of forces. These forces might be in GDP, they might be in sales, they might be in inflation, and you add a certain weighting to these to end up with your final answer. Farmer French was one that I read somewhere in my university textbooks during the days, and it basically looks at the market capitalisation of a company, as well as, I'm missing the last, what's the next one? Does anyone know the answer to the next part of the equation? No, okay, maybe no one actually pays attention. Beg pardon? I think that is it. Well done, thanks. And it just links them together. And funnily enough, it's actually quite a useful little formula, even if you did skip over it and only one person was paying attention. So it's very quite useful. And so that's where I'll lie into with information trading. So on the fundamental level we've just been talking about, really the prices merge together over the medium to long term. And in the shorter term, information trading can be immensely powerful if you are close by to your devices, whether it be a phone or you're at your trading desk or at your office or wherever it might be. Because there are always a set of numbers being released somewhere in the world, the US being the most prominent and the ones that are watched the most intensely, namely because they make up about 50% of the world's capital market. But I wanted to list a few of them here and just run through them. Ultimately, GDP, for us as Australians within the Australian economy or over in the US, is tremendously important, always watched. The cash rate announcement that comes out is also very influential. Back in February, the Reserve Bank of Australia dropped interest rates. Now, only about 50% of the market were anticipating this at the point in time, and so the market was actually slightly mispriced. So how does someone like Tom and I take advantage of that, or how would you take advantage of that? Simple. You'd have your trading platform up, you'd have a couple of buy orders ready to go on one side, you'd have a couple of sells matching them off on the left-hand side, and as soon as it's announced, cash rate has dropped, you hit buy. And the general idea is you've got an idea of which companies are going to move more with this sort of decision, and you're not exactly sure how much they're going to jump up because you don't know how much it's already priced into the market, but you do know there's going to be a move. And if you're quick enough just to go and buy, then 30 seconds to a minute later, you've already got your other order pad hooked up and you can click sell. And you might make 1%, you might make 2%, but magnifying that with leverage can be beneficial. Of course, there are risks with leverage, and I won't jump in them today, but as I said, please don't sue me if things don't go right. Just throwing ideas out there for when you are playing the game that we've got going on and how you can make opportunities of it. Otherwise, unemployment, particularly in the US, is very influential, as well as payroll, which is the number of new jobs that have come on board in that particular month. PMI and ISM are really around manufacturing and around inventory. And the more that businesses have faith in where the economy is going, will dictate how much they're actually producing. And it is a very strong indicator. Furthermore, something like construction, which is influential throughout ours and everyone else's economy, as well as something like commodity prices, which you can find out about daily. Now, there's actually a good website for anyone that is interested in this information trading, and it's called Forex Factory. They've got a breakdown of all data being released, and this actually isn't on your slide, so if you do want to make a note of it, please do. But it's called Forex Factory, and it shows where data is being released. So depending on what currency pairs you're trading or what markets you're trading on our global platform, we have some 30 exchanges around the world. So if you are busy during the day and you can't trade the Australian market, jump on to Germany. The DAX is actually quite volatile. The FTSE is great to trade over in London or New York or Tokyo or whatever you please. But this will have the data available. And with more or less a degree of accuracy, I've listed the almost in order of how you'd rank these numbers coming out. And here's an example of how quickly the market can move on an announcement. Here we've got the US dollar and Chinese renminbi, and how, if you actually go back in time, the renminbi for the past couple of months has been incredibly flat against the US dollar. Like, I'm talking almost no volatility, just little bumps along the road. And then out of nowhere, it actually just explodes. And you can see this candle is broken down into 3 minutes. And in a matter of 3 minutes, there was actually some serious money to be made. Furthermore, if you look at this chart on a daily note as well, the candlestick's just broken way out of control. And so there's been money to be made, both straight away and then over a couple of days as well. Now, if this pans out to be something like Japan, when they just surprised the market with an announcement on quantitative easing, no one was expecting them to say it. They didn't even have a proper scheduled monthly conference like the RBA has where they announce their cash rates. They just announced it. And if you're sitting at your desk, you would have made very easy money. And even in the couple of days to follow, there was actually tremendous money to be made as well. On something like, I don't know, I'm not sure how much uni students have to invest. Let's say you've got $10,000. You're a rich uni student with $10,000. You would actually be making about $10,000 in the next 2 or 3 days if you were close enough to that information and you had an alert on your phone or something of the sorts to go off. So just to give you an idea. So we've gone from the fundamental breakdown of how you might break down a stock. We've then talked about information trading and how quickly you want to move on it. Just wanting to really catch the general direction of where you're going. Now we're going to talk about technical trading, because nothing actually travels in a straight line. There is always a little bump along the road, and you kind of want to know how it got there, why it's there, and what's sort of driving it. I have no doubt that one of your lecturers somewhere along the line so far of your degree has probably told you technical trading is full of crap. And in some sense, he could probably argue it. He'd go on to say that the past does not represent the future. Snapchat was, when was it around? 3 years ago, 2 years ago it started up, and they had no idea it was going to explode into the way it has. There's no way you would have predicted that, and so the past didn't represent this future. And it doesn't work all the time either. I mean, if on the first day of November the market was always going to pop 3% every year, you'd just be the smart guy that got in the day before or the day before that. But the funny thing is, there is unusual anomalies in the market. One of the terms is actually called a calendar anomaly. And so, take Melbourne Cup for example. People are just more risky around Melbourne Cup. And so you'll catch a little bit more volatility. You'll actually see the market move a little bit more. Around Christmas time, it's quieter. The US go on holidays usually around July, August. There's an expression called May go away, and the market generally gets sold off. And so if technical analysis wasn't true, then you wouldn't pick up on these anomalies in the market. But in the arguments for, I want to run through a couple of things. Firstly, it doesn't matter on earth where the price is right now. You just want to know where it's going to be tomorrow or the next day or the day after that. You're just wanting to catch that bit of movement. And ultimately, everything in life does have a pattern. I get traffic lights are actually programmed to be in a pattern. But I can tell you that if you all held your breath right now, I can guarantee that you'll need to take another breath. The longer you hold that breath, the bigger the next breath will need to be to catch you up. But there is a pattern in that rhythm. And the same thing with trading is it's run by fear and greed. Patience can really be difficult to hold on to because you may have actually valued a company correctly. But if the market's taking too long to get there and heaven forbid going against you and you're down and out, you can lose faith in your idea and actually bail. And so that's where the momentum of this comes into play. I'll flick onto the next chart because this is one of a number of charts that has a head and shoulder pattern about it. And I've taken this off, I'm pretty certain it was Flight Centre. And I'll explain why this chart looks the way it does. Commonwealth Bank has got a bit of one going at the moment. Another company called AWC or Illumina has it going at the moment. And so what you've got is you've got the market at the beginning is identified that this is actually good stock. It's starting to go for higher and higher prices. The market sees that there's serious growth to be had and everyone starts jumping on board. You tell a mate who tells a mate who tells someone at a barbecue, you hear the taxi driver talking about it and it's all on like Donkey Kong. And then it hits its first high, to which people who hadn't got there actually kick themselves and they're like, oh, I wish I'd got in, it's too high a price now. And then there's a sell-off. And these are the guys that go, great, I'm going to jump in now. And they jump in again. And the market does edge higher and everyone's patting themselves on the back. The guys patting themselves the most is the smart money. They're the guys that kind of realize that this song has been sung and it's their time to peace out. And so they start selling off. The guys that didn't get in on round two are actually kind of kicking themselves again. Everyone's talking about it and they're like, oh, I wish I got in. Which then leads you to the third point, or the third circle we've got going here. And this high, or next high, it generally comes on lower volumes because the guys that are selling have got out in that drop. It's kind of got the sucker buyer in who's thinking it's going to rally again and they're going to be the ones making the money and joining their friends. And it just runs out of steam. There's probably been fundamentals along the journey that have changed. Flight Centre would have things like the Australian dollar changing. Maybe their margins are getting squeezed a little bit. Maybe they've got competition coming across abroad. And there's a number of factors coming into play. And maybe one of those factors or each of those factors have actually had a tilt in the market at each point in time. But it's all weighed on it. And now everyone's just like, it's time to get out. And the smart money is just selling off. And someone's in there buying. Of course they're buying because, well, trades are going through. But it can then just drop away and it really just does fade. So why would Flight Centre be worth any less a month or 2 months after today? And it's all just because people have just tired from it. You might have had guys with margin loans in there who'd gotten greedy, much like the Chinese market had. It had climbed 100% last year. And then people had jumped in, made money. Their friends had made money. Then the first guys are like, oh, I'm going to get all roided up. I'm going to take out margin loans. And then all of a sudden the market turns. Their wife's getting angry at them because they're losing money. They get a margin call. They're forced to sell. And the sell trickles through, much like happened in the GFC. So there is merit to technical analysis. And even if you thought Flight Centre was priced and it's convenient for this chart, but why not sell out and get back at a lower price once this flushing out has occurred? Because it'll lift again, but why hold on for a journey where you're making mediocre returns and not being more nimble in the process? And otherwise, there are simple psychological barriers. I'm happy to pay $4 for a bottle of Coke. $4.50, I'm kind of like, what's 50 cents? It's not a huge issue. But then funnily enough, add another 50 cents to that. And at $5, I really question how much I want Coke and how much I want water or how far I can walk to somewhere else. And if you guys can kind of relate to that idea, then the same happens with stocks. Approaching $10 or $20 or $100 are big levels. And so why not play that level? You can put in a stop loss or a profit target, knowing that when it hits, it'll either break through with great ferocity or it'll probably pull back and it might try it again or try it again after that. And it'll eventually break through. But profit from knowing this psychological issue remains within human beings and take advantage of it. And from there, I'll pass it over to my colleague Tom, who will happily tell you a bit more about the products that we trade and how to execute these trades. But otherwise, I hope you have found it somewhat interesting to hear about a bit of fundamental and technical analysis. Thank you.
Thanks, Hamish. So guys, as Hamish has said, my name's Tom. I've been working at Saxo for about a year now. I'm in the private sales desk with the lovely Marissa over there. I'm in fact still a student here. I'm just sort of finishing up my studies. They've sort of been on hold while I've been travelling and working here, so it's all starting to fall into place. But what I'm going to share with you today is just some of the products, or all the products that we have available on our platform that our clients use on a day-to-day basis. But I'll also just go in a little bit more depth about the 3 products that you will have access to on your demo account. So I'm not sure if you've sort of read into I suppose the rules or the guidelines of the game, but the 3 products that you will be able to trade are our single stock CFDs, our cash equities, and our foreign exchange, just the spot Forex as well. So I'll just quickly start with Forex. As probably most of you know, foreign exchange is easily the most traded asset or product worldwide. The daily turnover is about 5 trillion Australian dollars, so it's a massive market and it really draws in a lot of investors. Typically the moves in Forex are minute. These are magnified, or I suppose enhanced by leverage. So different brokers from across the globe will offer different levels of leverage. For most of our major crosses, so you're looking at dollar, yen, euro, dollar, and cable, so that's pound US, they're typically around 2%, so it's 50 to 1. And for Aussies and some of the other miners, you're looking at about 3%. For margin requirements, that's about 33 to 1 on the leverage there. They typically are a little bit lower, but we have seen some quite volatile times in the markets. We've had Greece just not knowing what they're doing, and they still don't. Also China as well. And of course we have the eagerly, I suppose the much anticipated rate hike in the US as well. So these are just added factors that you might come across when you're trading, and if you ever are trading in the future, you might come across with your broker. So on foreign exchange, there are about 160 crosses that you can choose from. As I said, we have the majors, the minors, we also have some exotics as well. So that ranges from spot gold and spot silver. Forex options are something as well, that are a product that we have available on the platform. Saxo Bank, we're one of the largest providers of FX options in the world. We actually are in interbank markets, so the prices we have are very, very tight and very close. We have 2 types of options on the platform. One just being our standard vanilla options, so just your puts and your calls, and also our binary one-touch and no-touch options. So the binary one-touch, no-touch options are a little bit different in the way they pay out. They pay out on a percentage basis of either you touching or not touching a certain price point. And I think, guys, you're probably all familiar with the calls and puts from Corp 2, so I won't go into that too much. Now, equities, of course, everyone here is very, very familiar with. Something we've grown up from a young age, and we do have a lot of exchange. We have 36 global exchanges. I think Hamish touched on it earlier. So if you guys are busy at uni, you've got work during the day, you can't trade the ASX or the Singapore exchanges, you can always jump on late at night. You can trade the Dow, the S&P. We've got the DAX. We've got everything. So there's a lot of stocks, both locally and internationally as well, that you can take advantage of. Please note that when you are trading equities, or if you do trade equities in the game, you can't short sell our cash equities. It has to be done via our CFDs. So our CFDs are just contracts for difference. So these are OTC products, and they're designed to mirror the underlying asset. So we have CFDs on a number of different products. We have our commodities, our indices, of course our stocks, our foreign exchange, and our exchange traded funds. You guys have access to the single stock CFDs. I will show you on the platform as well later on where you can check the information for margin requirements and also if the CFD is shortable. There's no doubt some of you will be wanting to short some CFDs in the game. Futures contracts, I probably don't need to touch on too much. It's probably one of the larger traded assets across the globe as well. We have a lot of futures exchanges. We've got the CBOT, the CME, of course the Sydney Futures Exchange. So just hedgers, speculators like to use it. And it's it's actually one of the probably most traded products on our platform as well. Contract options. So unlike our FX options, which are OTC, these are exchange traded options. The reason that ours are exchange traded options is that they track our futures contracts. So our futures contracts are direct market access, so they go right through the exchange. We don't make our futures, so there's no broker on the other side moving stops up and down, etc. So it is directly through the exchange. And of course, we have some bonds as well. So we have just your corporate bonds, your sovereign bonds, etc. So we have two platforms, I guess you guys can choose to use. We have the Saxo Trader and the Saxo Go. The Saxo Trader is the platform I'll be giving, I suppose, a main demonstration on. So I mean, being a uni student, I know that most people have Macs. Does anyone have the Microsoft Parallel software on their Macs? Okay, or PC at home? Okay, maybe, all right. So with the Saxo Trader, unfortunately, you can't actually use the Saxo Trader on a Mac unless you have the Parallel software. It can be used on a PC, but I'll give you a brief demonstration on the Saxo Go as well. So the Saxo Go, you can just log in via our website. I'll show you where to do that, and you can just use it on any old computer. You don't need a PC or you don't need the Microsoft software. So the Saxo Go is a very, very new platform with Saxo. We spent a lot of money, a lot of time developing it. It was only released about 3 months ago, I think, and it was really initially designed to enhance our tablet and mobile apps as well. It's a really great platform. It's very intuitive. While it doesn't have all the bells and whistles of the Saxo Trader, it's very, very good. It's got fast execution and the charting package is fantastic. So I will show you, I'll show you both just briefly. So what I'll do now, let's just quickly get this up. Okay, so this is, I've just started, before we started, I just sort of chopped and changed a few things around, just a very simple workspace, guys. So if you're using the Saxo Trader 2, this is the interface or the workspace you'll be using. It's a very, very good platform and it's very easy to use. So I'll just start, I guess, with the trade ticket. So this trade ticket, guys, is just your multi-asset, multi-product trade ticket. You can trade all three asset classes, your single stock CFDs, your equities and your FX through this trade ticket. I suggest to use it. I was actually speaking to Hamish as well. I'm not sure if we can organise, I suppose, a saved workspace. I know we do have some saved workspaces on our website, which I'll show you as well. So you can just download those and use them and just load them onto your computer to save setting up. It'll save you some time. So let's just type in, I suppose, Aussie dollar. So in order to search for a product, you just simply type it into the top here. You could just be choosing anything you want. So just type in Aussie dollar for simplicity's sake. Okay. So with the trade ticket, guys, in order to place a trade, there's two ways you can do it. I'm not sure which strategies you guys will be using, whether some of you will be looking to scalp or some of you will be looking to buy and hold for a long time, or I guess for over the 3 period. So in order to, we'll just quickly enable trading. So you can easily just trade off the bid and the ask. Personally, when I do it, sometimes I trade off the bid and the ask, sometimes I place an order. It really depends what I'm doing with my day. And again, as well, with the strategies and I guess how the market's performing. I'll get back to placing orders in a second. Now, a watch list, guys, is something that you may find useful and you may not find useful. It really just helps you keep a track of all your instruments, all your asset classes, and what you really want to look, I suppose, keep a track of. So just in order to add an instrument, just right click, and we can just have a look at maybe something that's open. So we'll just bring up some majors. So let's have a look at Aussie CAD. So there you go. You can just bring up in your watch list. You can have a look at the bid, the ask, the last trade that I believe is there as well, and the percentage change from the day. So it might be something you want to use. It might be something you don't want to use, but it is there for you. I'll just go to the Forex board. So Saxo, when we were established 21 years ago, we were primarily a Forex broker. So there's some idiosyncrasies in the platform that you won't find, of course, you won't find anywhere else. The Forex board is one of them. So the platform was developed primarily for Forex brokers, and the Forex board is a great tool. It actually allows you just to add, and it's almost like a foreign exchange watch list where you can just add as many crosses as you wish, and you can actually trade off this watch list. So it does help with the high speed, high frequency scalping, which some of you may wish to do. I'm not sure. But it's a great tool you can use. Now the charts is probably charting package is very good, and it's certainly a very excellent charting package which you can implement. I'll just quickly show you how to use it. Okay, so bring up Aussie dollar.
Actually, Tom, bring up a USD CHN on a daily chart and just show them how much the renminbi's popped, or the US dollar's popped.
Okay. Okay, so there's a good example, guys, of what's actually going on. This is a very, I suppose, it's a rare chart. I'm not sure if any of you followed what happened with the Swissy as well when they decided to unpeg with the euro. It caused havoc in the foreign exchange market. And really just sort of screwed a lot of people over and a lot of brokerage firms over. So as you can see here, it's just had a massive pop. I think I remember when we were sitting at a desk when it sort of came out, when it was being devalued, it sort of got really frantic. The charting package, of course, we have several types of charts you can use. I'm not sure which charts you guys are used to. The stock standard charts, which most people use, are just the candlestick charts. We have line charts, area charts, and bar charts as well. So there's a range there you can choose from. So Hamish was mentioning earlier just about some technical analysis. The great, I suppose, a great feature with our charting package is the annotations. So the annotations will allow you to, I suppose, identify certain levels, certain resistance, certain support levels, head and shoulders as well. So these are things that you can save on the chart. So if you are, I suppose, looking back, you want to study a chart before you're looking to invest or make a trade, you can always leave it there and refer to it at a later date. So I'll just give you an example. Let's bring up dollar yen. It's got a pretty good example. Okay, so if we just go to dollar yen. Let's go back to a daily. Okay, so dollar yen, as you can see as well, the dollar has been strengthening against most currencies. Again, we're sort of eagerly awaiting what's going to happen with the rate hike. I'm not sure what everyone thinks, if anyone's been looking into it, if it's going to happen September, December, but we'll wait and see. The annotations just here, so you can use your lines. As you can see, there's quite a solid uptrend just here, and it's really keeping above it. It hasn't really broken, it just keeps bouncing above it. So Hamish was saying before about identifying some technical analysis, I suppose, looking at certain levels. It's quite interesting how often they actually do hold up. Let's have a quick look here as well. Another, I suppose, great feature about the charts as well is you can actually buy and sell off the charts. So I'll show you a bit later as well, where I can set up multiple charts on the one view. You won't have a trade ticket on that view, so being able to buy and sell the charts is really good. It's something that a lot of our high frequency traders use on a day-to-day basis. So let's just have a look. We can look to sell. Just drag it up to any indicative price. Just select your amount, place order, okay, and it'll pop through. So each time you guys place an order or place a trade, you'll get a confirmation that comes up. I know it's just plain money, but if you guys are really looking to win, just make sure the details are correct. You might just fat finger, you might put an extra zero, I might go on at the wrong price. So just make sure you do double check that. Okay. I'll quickly show you as well. It's quite a nifty feature that, as I said, a lot of our high frequency traders use, especially when they're looking at a lot of different crosses. And that's having multiple charts open on the one view and trading off the charts. So I'll just quickly show you to do this now. So in order to do this, you just drag your chart out. I'll just do it really rough, guys. Just click on this icon here, clone your chart, and just drag it out. So you can do this as many times as you wish. You may wish to have a look at, I suppose, 8 or 9 different charts, or just as many as your screen can fit. And you can bring up different crosses. It doesn't have to be the same cross or same stock or same CFD on the chart. You can have multiple crosses. So for example, bring in dollar euro, euro Aussie, and we might bring in dollar yen. So just wait for those to load up. Slide to load. There you go. So you can go, this is something that, as I said, a lot of high frequency traders use, and something you guys can utilize as well, if you like looking at multiple charts. Okay, so what I'll show you now is just placing trades, and also I'll go through amending orders as well. It's something that if you guys, I suppose, it's probably the most important part, because if you want to win, right, you've got to know how to place the trade. So what I'll do is I'll just use Aussie dollar as an example, and I'll just go into the order ticket. There's a few more fields that need to be filled out here, but I'll go through them slowly and individually. So it's pretty self-explanatory, the first two. Simply just your amount, so we'll just stick with 25,000 for example's sake. Buy or sell, of course you can short Forex, so we might just short, go over short. So the different entry types you can use, there are a lot, and you use them, I suppose, in different times of the market, when the market's volatile, if you're not going to be at your computer for prolonged periods of time. There are various different reasons why you use the different entry types. I'm not sure how familiar you guys are with the different entry types, but I'll just run through them quickly and try and give, I suppose, a good example of each. The first one is a limit order. So a sell limit, I suppose, we'll just go buy. Just do the opposite. So we'll just long it. So a buy limit, you're essentially saying, if you want to buy a limit, is you feel that the price of, say, dollar yen is overvalued, and you want to pick it up at a better price. So right now it's trading at 124.56. So you might think, okay, that's a little bit high. There might be some pressure. There might be a bad number coming out. I want to pick this up at a lower price. You might not want to short that because you're not quite sure that it will decrease in price or devalue. So let's just say we might put it 56 pips to 124. So we can just set in a buy limit. 124. Oh, it's Aussie dollar, sorry. Dollar yen. Okay, so we might have, say, a buy limit at 124. So that means once the price of dollar yen hits and falls below 124, your order will be triggered, and you will be pretty much filled instantaneously with FX. So you'll have the 25,000 sitting there. A lot of people like to use these, as I said, around announcements. For example, if you're expecting a rate cut, you might just want to pick it up underneath. A good example of where a buy limit might come in handy with a rate cut was the last Australian cut. So when it cuts, of course, you can expect the currency to decrease, and as it did. It dropped 50 pips, I think. 50 pips is not a massive move, but it's not a small move as well. It probably happened over the space of 10 minutes. So when the RBA announced the cut, it dropped like everyone expected. The only thing, I suppose, the only difference in this case, in this scenario, is that when Glenn Stevens released his statement, the statement was actually quite dovish. And by dovish, I mean they didn't really indicate that there were going to be any more cuts, certainly for this year. And it actually rallied up, about 200 pips. So if you're a trader, and I suppose it takes a lot of foresight, and I suppose you've got to be very, very experienced to see these patterns happening or think about these patterns. So where a buy limit around an announcement can be very, very effective. So if you had a buy limit 50 pips on the market, you would have bought Aussie dollar, and you would have absolutely rode the momentum up. You would have made thousands of dollars. So that's one way, or certainly one area a buy limit can be used. The next one, guys, is just a market order. A market order. That's fairly self-explanatory. It's just getting in at market. So a stop order, a buy stop order, is an order. It's a little bit different to a limit. So if it's a buy stop, it has to be set above the market price. Stop orders are used in, I suppose, many different, for many different reasons. I suppose one reason, really switched on traders use it for is around big levels of resistance. Or if they might find some technical areas where they feel that if a stock or a cross or a pair was to break out of a certain range, they're going to rally, and it's going to rally a lot, and they're going to ride the momentum. So I guess I suppose a semi-example would be, let's have a look here. Suppose about there, I guess we could say, just for example's sake. It's dollar yen sort of hit the top, it's sort of consolidated below that range, and once it's broken out, it's really broken out. And one thing you guys should notice is that that old resistance level's become the new support, and it's bounced off it again. So that's one area I suppose really switched on traders will sort of use these stop orders. They really like to ride the momentum, and they really like to make large profits off it. I guess if you're buying and holding, people use stop orders. I suppose if it's not around a computer for prolonged periods of time, and they just sort of want the position if it was to go over that price. So you can mix and match and use it however you wish. One thing I should mention with these two orders, guys, is that although you've got the order sitting there, there's no guarantee that you will actually get the position. And of course, it's quite intuitive. If the price just doesn't go below or above the price level, you can miss out on the trade. The buy limit's probably one where you need to be extra cautious, because if you've got a buy limit, the price of the stock, for example, may decrease, but it may just decrease, so 5 cents above your limit price, and it might just rally up on there. So, I mean, over the 3 weeks, there might not be an instance where it has affected your position, but it is important to monitor, because you may just miss out on that trade. And who knows, it might be the trade that wins you the game. So I'll just quickly show you a couple of more on a CFD. So let's just bring up Woolworths, for example. Okay, so the third one is a stop limit. Now, you won't see this too often with foreign exchange, but it is very evident in CFDs and the stocks. And that's the thing called gapping or slippage. So gapping or slippage, I'll just show you an example. Let's have a look at Combank, would have been gapping a fair bit. For the side to load. Okay, it's a really good example. So Combank, of course, most of the banks have been hammered recent times, just been doing some capital raisings, etc. And they have been gapping down. So a gap is just when the market's not very liquid, especially with that stock, and it actually falls through the price at which it closed at. So right here, you can see just here, there's a big gap down. So if you were to say had a buy limit at say 87.50-ish, just for example, and it's gapped down there, you can see it's open quite a way below that. Your shares would actually be filled at that price. You're not going to get filled at the predetermined price. So something to be extra cautious of, guys, especially right now we've got the banks, they're doing some capital raisings, China's just going absolutely ballistic. So it's important to keep note of, and I suppose if you're checking your positions and you've noticed that you've been filled at a lower price, or you've sold at a higher price, or vice versa, not to get too alarmed. It is just, I suppose, the nature of the beast. A good way to, I guess, limit or I guess to limit the slippage is by using a stop limit order. So a stop limit order combines the stop and the limit, whereas hypothetically, if we have a buy stop limit, the first price, so if I just click on it here, the first price will be your stop level. So that's the price in which you wish to start buying the stock. And the limit price is the price at which the maximum you're willing to pay for the stock. So you'll only be buying the stock within those certain ranges. Amid times of high volatility and 4 cents in the market, it's quite a useful entry type or order to use, just because it does sort of guarantee you the sort of the price range which you think is a fair valuation of a certain stock or currency. The last order is a trailing stop. Now, a trailing stop is something that I suppose an order that a lot of our clients use. It's there to protect your profits. So just hypothetically, you've got into Combank and you've got in at the lows, you've got in, say, about 82, all the way back in January. And, it's doing really, really well. There's a big uptrend there, but you're just not quite sure what's going to happen. There might be a sudden announcement. Who knows what it could be to cause an absolute catastrophic downturn. So the trailing stop is there to I suppose, protect the profits you've made, and it is quite useful. So if I just click on it here, you'll see the first number here. So that's your distance to market, and that's where you want the trailing stop to start. So I think it's 14 cents. So if you had a trailing stop with a distance to market of 14 cents, it would start 14 cents below the current market price. Now the trailing step is the increment level in which you want the trailing stop itself to move up as the price of the stock moves up. So if you've got a trailing step at, let's just say 1 cent, for example, for every 1 cent movement, the stop itself will move up 1 cent. But let's just assume we have a step of 10 cents. For every 10 cent movement, the stop itself will move up 10 cents. However, if the stock only moves up 9 cents, the stop, it won't move up. There'll be a 19 cent gap there. Yeah. So it has to move up a full 10 cents for it to move up 10 cents. So that's something to be aware of as well. I mean, the game is only 3 weeks, so it might not be something that you guys use, but it might be something you guys use down the track. So what I'm going to do now is I'm just going to put in I suppose, a sample trade. I'll just do a foreign exchange one just because it's open. Okay, so let's just buy a lot. So we've got 21 million. We're just going to buy at market. Market orders, of course, Forex has to be a day order. Now, one thing I should mention as well is our OCO orders, or one cancels the other. OCO orders, again, are quite a useful order that a lot of our clients use and a lot of clients worldwide use. So, of course, the first one is your take profit, or your limit. So, of course, as the name suggests, it's the level in which you wish to take your profits. Of course, if you're longing, it's above, and if you're shorting, it's below. The stop if offered or stop if bid, we'll just put a stop, is of course where you wish to just sell out or buy back at a loss. So it's something that you guys might want to incorporate, I guess, if you're at uni and don't have time to check the markets all the time, especially if you are trading FX. You might just want to protect your positions or just take your profits as quickly as you can. So look, anyway, I won't, I know you guys are probably getting a bit restless, so I'll just quickly place the order. So as you can see, the confirmation's come up. I've gone at market, and I've purchased my 21 million yen. So this is probably the last couple of points, guys. So as you can see here, I've got quite a lot of positions there. I've just been playing around with it the last couple of weeks. So the positions tab is, guys, something you should probably take a lot of care with and really just check it on a daily basis. Simply because if you do have orders in there, you just want to check they've actually been filled. And of course, if you're making money or you're losing money. So as you can see here, the dollar-yen position's gone in. I'm long 21 million. I'm currently down about 3,700 US, but that's okay. There's a couple other big ones there. Aussie dollar one's not going too badly, but yeah, it's just some practice ones. Now, guys, I was showing you how to place the orders in the trade ticket. But if you wish to, I guess, amend these trades or amend these orders, you can do so here. So the stops and the limits, the OCOs I just showed you, you can actually set here just by clicking on the limit and, of course, just filling it in, I suppose, the appropriate price. You can also close your position here. Now, guys, this is probably the best place to close your position simply because, I mean, you can use the trade ticket and, of course, just do the exact opposite. That does leave room for a little bit of risk. You could fat finger, you could type in an extra 0, and trust me, I've had times where people have called me up and said, oh, I've actually still got exposure to this, and said, well, you know, you've actually accidentally just fat fingered it. You've actually got a lot of exposure to the market, which they don't want. So that's something to keep in mind, guys. In order to close out a position, simply just hover your mouse over the indicative close price right here. Click close, wait for it to load, enable order, close position. So it'll close out, you'll get your confirmation, and just double check that it does say square or closed. As it does here, it says closed and square. So you've got no more exposure, and that's the trade done and dusted. If you have put in your OCO orders, guys, they also, I suppose, what's known as a related order. So those OCO orders, if you have placed them, you won't be able to close out in the close bar. You'll actually have to go and cancel them in your open orders. So hopefully I've still got some, yeah. So here I've got an OCO just for $yen. It's just sitting there. That is for a separate trade. So if I wanted just to close out a market, I'd actually have to cancel this order. If I wanted to cancel it, just click on here and start. It'll process and it'll cancel the order for you. So again, the orders tab is probably something as well you probably want to keep an eye on. If you have got a lot of OCO orders in there and you're looking to get out quickly, especially if you're just trading off the bid and the ask, you'll be able to do so as long as the OCOs have been cancelled. So that's something certainly to keep an eye on. Just quickly, guys, something else I'll show is our news and research. So we have a really great tool. It's called our technical analysis tool. I won't go into too much depth of it today because probably want to just wrap it up. Just while we're waiting for that to load, you can actually filter certain stocks and certain CFDs and whatever it is, an FX pair, to a bullish and bearish trend. So you can just have a play around with it. You can have a look at certain courses and tutorials which will educate you on identifying certain pennants, bullish, bearish wedges, and anything along that nature. So they're all just here. So if that's something that does interest you guys, you want to sort of utilise it during the 3-week training game, please by all means do. The last but not least is trading floor. So trading floor, guys, it's a website that's been developed by Saxo across the years, and it has, I suppose, it's a blend between Twitter and Facebook for traders. It was created solely to follow traders, follow their trades, but we've also now got our economists and strategists from across the globe posting reports now on a daily basis. So it's something that you guys should utilise. It's got a lot of good information on it. They also generate some trade ideas as well. So if you guys are looking to get ahead of everyone else in the game, it might be something you might want to look at. There's some really, really good tips on there. Our economists are actually world renowned. Steen Jacobsen, who is our chief economist, does a lot of travelling. He's even done some seminars in Sydney recently. He's on CNBC, Bloomberg. He does the trip, he does the rounds. He's on quite a lot of shows and he's very, very insightful. He also reports on here. So if you want to look at some of our strategies, you can just come and look at the Forex board. John Hardy, he's our senior Forex strategist. He posts a lot of trade ideas every day. And guys, he's been pretty spot on recently. So if you really want to looking to get ahead of the market, I'd come here, look at John Hardy, he's fantastic. Most of his trades are pretty spot on. So it's certainly a good place to come and if you guys are looking to win, I'll definitely check it out. To log in, you can just register, it's for free. Just simply come up here. I'm logged in, so you just have to log out and just sign up here. Just simple, just entering your details, email and password, you'll be able to log in. Now guys, sorry, we're going to have to just go through the boring bit, that's just the T's and C's. But I'll have to do it very, very quickly, I'm sorry. You guys have been very patient, so that's great. I'll just quickly bring it up here. Okay, so just so you guys know, the registration period is closing on Sunday. So that's this Sunday, the 16th of August. It closes at midnight. So if you haven't registered, please do so. And just so you don't miss out, because the last thing you want to do is actually start trading. You're doing really, really well, and you're not registered for the game. The competition period is between the following, so Monday week, the 17th of August, and to Sunday, the 6th of September. And again, the trading competition stops at midnight. So obviously to qualify as a participant, you must be a university student, etc. You're only permitted to enter once. Now the results will be posted on the 11th of September. They will be published on our website, which is www.saxomarkets.com/trading game. I'm sure you guys have already visited the website, so please just monitor that. I'm not sure if we'll be updating results and who's on top of the leaderboard, etc. Now the prize pool, guys, I'm not sure if you guys have I got everyone's attention. So the prize pool, I'm not sure if you've sort of had a look at it, but it's a $2,000 prize pool. So first prize is $1,500 check, and 1 week of shadowing one of our senior traders. Second prize is a $300 check and 1 day of shadowing our very experienced traders. And third prize is a $200 check. Please note that we will contact you within 14 days, and you've got 14 days to respond, otherwise it just goes on to the next person. The prizes are non-refundable and non-reimbursable. Now guys, just I suppose a bit of incentive. Last year's game was 2 weeks. Our winner started at 100,000. He made 500% in 2 weeks, which is just absurd. He is actually now a big prop trader. He's turning over, I think, he's trading in foreign exchange, and he himself is probably trading well into $2 or $3 billion a day in turnover. So that's sort of a target for you guys. You guys have got an extra week, so I'm not sure, maybe that's a good head start. He was staying up all night, so there's no need for you guys to do that. But yeah, as I said, he actually got a job offer when he walked in, so I'm not saying that's going to happen to you guys if you guys get there, but he did get the job offer, and as I said, now he's prop trading. So yeah guys, thank you very much for listening. I think we've got some food and nibblies.
Hi everyone, so there's going to be pizza outside, so if you'd like a slice, just move outside quietly. Thank you. And if there's any questions, we'll be here as well, down here, with Tom and Hamish.
No, I'm okay. I realised. That's okay. Very kind. You don't need the pizza, I'll try it. Oh, mate, I feel very flattered.
Thanks so much, guys.
Appreciate it. Thanks, mate.